Hello, everyone. Welcome back to Financial News. I'm Ron Jankowski with Channel 4, and my co-host is Paul Munico with Ameriprise. Good morning, Paul.
Morning.
Are you ready for the snowfall coming this week?
As ready as I can be.
Okay. Today's January 31st, 2022. Paul, lots of activity. Some of it not good, some of it okay. Why don't you give us an update what took place?
Absolutely, and I am going to comment today on what's been going on in January and a little bit of an update on what we expect overall on the year. So anyone watching the market is aware that market volatility spiked in January. But investors should consider to remain optimistic about the year ahead. At Ameriprise, we published an update to what we call our quarterly capital market digest report. And that report includes ties to our longer-term strategic themes and also that quarterly market monitoring report. It acts as kind of a quarterly check-in on our year-end targets, scenarios, and forecasts. So today, I want to go over a snapshot view of some of those points, beginning with the tactical highlights for Q1. Looking at the macro environment, market expectations are for tighter Federal Reserve policies have shifted higher at the start of the year. And in combination with elevated inflation pressures, bond yields have also shifted higher. So as a result, stock prices have moved lower to start the year 2022. Now, particularly in high growth areas where valuations are most contingent on future profits and growth. Nevertheless, our expectations for still above trend economic and corporate profit growth this year suggest investors should look through the near-term volatility if they are able to and focus on the longer-term potential. The fundamentals. Although we expect economic and corporate earnings growth to decelerate markedly, we do believe both should remain favorable. The deceleration, combined with a tighter Fed, could create periods of more volatility across asset categories. When it comes to the portfolio, choose your stocks wisely and consider if the risk is appropriate for you in terms of bonds. And also in the bond category, look at your risk characteristics and see if they fit. Cyclical areas in the US and Europe, we recommend to take a look and focus maybe on quality investments in those areas. Again, everything is going to be relative to your needs, so talk with your financial advisor on what may be best. Consider, if you haven't, alternative strategies and dividend-paying stocks to maybe help mitigate some risk. The new year, we do know, is off to a rough start. Again, bond yields have pushed higher, stock prices have stumbled, and volatility has jumped. The proximate cause of the turmoil has been increasing anxiety about how far and how fast the Federal Reserve will tighten monetary policy. And the resulting rise in bond yields has, in turn, pressured high valuation growth stocks and pulled major averages lower. The ongoing grip of the Omicron variant has also caused economic activity to slow. Nevertheless, though, it remains our view at Ameriprise that the U.S. economy is poised to grow at a relatively healthy, above-trend pace this year. Of course, that can change at any time, given any unexpected events. We do expect inflation should begin to slow towards mid-year and corporate earnings to grow at rates close to their historical averages of about 8%. Now, this combination of conditions should lead to a fourth straight year of potentially positive returns for U.S. equities. That's in our view. Now, however, it should be expected that the S&P 500 return a much more modest price-only gain relative to the plus or minus 24% price return average we've seen over the past 3 years. With that said, we believe the recent pullback in equity averages provides a better entry point to look at the market and consider potentially putting some of that cash on the sidelines to work if right for you and your investment needs. Or it's a good time to look at your portfolio to make adjustments to help capture the next uptrend. We always suggest that long-term investors further review the volatility and selling pressure if it continues as a healthy development that can potentially foster a better market environment ahead rather than the potential end of a bull market. As always, I can get further details on this category should you like to see it in terms of global asset allocation as well. We're looking there for recommendations. We're happy to provide further detail on any of this. So if you want any more information, please refer to our quarterly updates and or reach out to me and I can get you more details.
It'd probably be the best thing for those people who do not know how to access that is to just contact you and you can provide them with more information. As of this morning, Ameriprise has also sent me the following information, and I'll share this with you, Paul. U.S. stock index futures are lower this morning after Friday's strong gains kept the S&P 500 from posting its fourth consecutive week of losses.
Tons of volatility, and as we've been reporting every week, the market's been trending down so far this month. Negative futures kind of go along with what's been happening.
And the tech sector generated a 4.3% gain on Friday, with the mega cap name following Apple's lead.
Yeah, the tech sector, and again, as I kind of stated in the beginning part of the show, has been down a little bit greater than the S&P 500 stocks. So again, nothing out of the ordinary there.
And the European markets are mixed at mid one day, while the markets in Asia close higher, but several markets are closed due to a holiday, Asian holiday.
Europe is just as confused as we are.
Yeah.
They're worried about Omicron, they're worried about inflationary, they're worrying about war pressures. So the world has the same problems.
Yep, all over.
Right.
And the Treasury yield curve continues to flatten with a 10-year 1.8% and the 2-year at a 1.2%.
Yep, and remember, typically if bond yields are up, the prices for those bonds are down.
The year-to-date market returns are, of course, all negative. They're S&P 500 -6, Dow Jones -4, NASDAQ -11.
Yep, and I think that is through Friday, which did include some of those up markets, and we'll see what this week brings.
Okay, well, thank you, Paul. Excuse me for that report, and we will be back with a show called Your Money. Paul will be talking about a particular topic. Stay with us. We'll be right back. Thank you for staying with us. We are back with our show called Your Money. The topic today is financial planning fundamentals and financial planning in those fundamentals. Paul, I'm going to let you take it and share more details.
Absolutely. Thank you. Financial planning can help you gain a better understanding of where you are at financially and how to prepare for challenges that may be ahead, and how to plan for where you want to go. So if you do not have a financial plan prepared for you or your family, a financial advisor can help. There are the typical steps of the planning process. Number one, you're going to want to set goals. In this foundational step, your financial goals take the spotlight. This is your opportunity to identify what you hope to achieve during your lifetime and when you'd like to get there. So for example, you may want to own a home in 3 years and start a family in 5 years. Or you may want to return to school to pursue an advanced degree, which may incur short-term costs, but help you earn more in the long term. Or you may want to retire early and travel the world. In order to achieve any of these goals, you need to name them first. Once you've got those goals established, it's time to do some fact-finding. So during this phase, you will gather the numbers to see how things add up. Your financial advisor may ask questions to calculate your personal balance sheet which estimates your net worth based on assets and liabilities. Your income, spending habits, monthly bills, and outstanding debts all need to be laid on the table. The price of future goals needs to be quantified so that you can determine what you need to save to afford them. If your goals don't match the reality of your financial circumstances or the other, something needs to change. Next, plan creation. A comprehensive financial plan plots how to reach personal and professional goals within the context of actual income and expenses. With a clear line of sight into your financial status, you can look for opportunities to trim unnecessary expenses and redirect money towards your goals. Again, your financial advisor may also provide investment strategy, asset allocation, and portfolio recommendations based on your individual goals and personal risk tolerance to help optimize your finances. The next step is strategy implementation. So this is where things get real. If your plan requires you to save a certain amount of money each month, then it's up to you to make it happen. If reaching your goals means you need to increase your income, now is the time to put in the extra effort to get that promotion or switch fields to pursue increased compensation. Your financial advisor can help you select savings vehicles that are suited to your investment goals. Last but not least, you need to have ongoing plan reviews. So ideally, your financial plan is a dynamic document that is adjusted periodically to reflect your life circumstances. Your financial advisor will recommend at least one annual meeting to check in on your progress towards your goals and fine-tune your financial plan. Financial planning takes work, but the process can be very rewarding. Larger goals become easier to attain when you can take small steps to reach them. It's never too early or too late to put a financial plan in place. And again, I can't stress it enough, a financial advisor can help you create your plan and manage your investments to help you realize your life goals.
Good report, Paul. And again, it's always the same thing. Make sure you have some guidance, and if you don't have, you're available to help. And you want to give your phone number? And
Absolutely. You can reach out to me for help with your plan or a second opinion to who you are working with. I'm here to try and help. And again, I can't stress it enough, whether you're 21 years old or 81 years old, it's never too early or too late to start this plan and make sure you're on track to do the things that need to be done. So give me a call if you want help with that. My number is 708-226-3412.
okay. Thank you, Paul, for coming out and sharing that topic with us. For Paul Munico with the Ameriprise, myself, Ron Jankowski with Channel 4, we wish you good investment day.